Welcome to This Explainer. Look, I am absolutely thrilled you're tuning in today because we are about to tear down some massive, widespread misconceptions in the financial world. If you've spent literally any time looking at trading content online, we all know you've seen the ads. You know the ones. Build a trading bot in 10 minutes, or let our algorithm generate passive income while you sleep. Well, we need to talk about this because today we are delivering a pretty harsh reality check. We're going to dive into a really fascinating breakdown of what quantitative trading actually is. And more importantly, we're going to see why the dream of building a fully automated, completely hands-off money machine as an everyday retail trader is, frankly, a total illusion. I want to start right off the bat with this brutal, yet honestly incredibly accurate quote from our source material. You are bringing a fruit knife to a battlefield. I mean, hit pause and really think about that for a second. When you, sitting at home, try to play the pure quantitative trading game, you aren't just the underdog, you are fundamentally outgunned. The sheer massive mismatch between the everyday person and the institutional giants dominating the space is just staggering.
All right, let's jump into section 1, the quant trading illusion.
To really understand why you're basically holding a fruit knife out there, we first need to strip away all those emotional myths about simple trading bots. We need to define what true quant trading actually entails. Because spoiler alert, it is not just writing a quick script to buy when two moving averages cross on a chart. The reality is so much colder and infinitely more complex. Think about the true quant focus for a second. We're talking statistical anomalies, massive computing power, hard data, and probability. Notice what's missing there? Yeah, human emotion. Pure quant models do not care what the Federal Reserve Chairman said on TV this morning. They definitely do not care if a candlestick chart pattern looks visually pretty. They strictly hunt for mathematical anomalies using raw, sheer computing power. They only care about standard deviations and precise probabilities. That's it. So just how extreme is this hunt for data? Try 5 milliseconds. Our source gives this terrifyingly fast example of what real quant trading actually looks like in practice. Instead of trying to guess if the price of gold is going up or down tomorrow, a pure statistical arbitrage model calculates the historical correlation between gold and the Australian dollar. If that mathematical correlation temporarily breaks down for just 5 milliseconds, the algorithm instantly buys gold and shorts the Australian dollar to capture the tiny difference when the correlation fixes itself. 5 milliseconds. You literally can't even blink that fast. Moving on to section 2, an asymmetrical war.
If you're out there trying to become a pure 100% automated quant trader, and you're competing against massive hedge funds like Renaissance Technologies or Citadel, you really need to understand the forces you're up against. Let's look at the retail side. You might have your 1-minute candlestick charts on TradingView and a standard home Wi-Fi connection, right? Well, to an institutional fund, your 1-minute data is practically ancient history. They are paying tens of thousands of dollars a month for tick-by-tick data and incredibly deep order books. And their speed? It's nuts. They literally co-locate their servers physically next to the stock exchange and use highly specialized microwave fiber optics to execute trades in microseconds. Before your algorithm even recognizes a price difference, their computers have already eaten the profit and swept up all the liquidity. Your order hasn't even left your Wi-Fi router yet.
This whole asymmetrical warfare setup leads us to a pretty grim statistic: 99%. According to the analysis, 99% of retail trading bots just completely fail when they are put into real-time live market trading. And here is the real tragedy of it all. These retail bots often have picture-perfect historical data. The creator looks at their backtest, they see the chart going up and to the right, and they think they've just printed $1 million. But the absolute second real money is on the line, the account blows up. So why does this happen so consistently? The answer is overfitting, or as it's often called, the backtest illusion. Because retail traders usually don't have advanced statistical training, they end up tweaking and forcing their code to perfectly match whatever already happened in the past. It's exactly like memorizing the answers to last year's math test, right? You look like an absolute genius until you sit down to take this year's test, and oh wait, all the questions have changed. Overfitting completely destroys a model's ability to actually predict future real-world outcomes. You aren't building a predictive model at that point, you're just drawing a really nice line over yesterday's news. Let's pivot to section 3, survival tactics for retail. Okay, I know that first part sounded incredibly bleak, but we are going to pivot away from the despair of pure quant trading and actually empower you with some actionable strategies here. Because while you absolutely shouldn't try to fight Citadel on speed, you can totally use a quantitative mindset to survive and actually thrive. The absolute most important rule you need to remember is this: stop playing high-frequency trading. You will lose. Every time. Instead, you need to start using what's called semi-quant. Think of this as adopting a quantitative methodology specifically for risk management and data filtering, rather than trying to fully automate every single microsecond of a trade. The goal is simple. You want the machine doing the heavy lifting, but you keep the human, that's you, firmly in the driver's seat. You can actually physically protect your capital using some very specific semi-quant tactics. Instead of just guessing how much money to risk based on a gut feeling, you can use the Kelly criterion. This is a brilliant mathematical formula that calculates your absolute optimal position size based on your actual historical win rate and your risk-to-reward ratio. Boom, it instantly removes the emotion of sizing. Even better, you can code a max drawdown limit. Imagine writing a really simple script that automatically locks your trading account for the day if your losses hit 5%. That means no revenge trading, no emotional spiraling. The math just steps in and literally saves you from yourself. And you can apply this semi-quant approach directly to your investment strategy too, through something called macro factor investing. Here is a quick step-by-step example of how this works. Step 1. You write a simple Python script to automatically gather massive amounts of macro data. We're talking interest rates, inflation numbers, M2 money supply, the whole shebang. Step 2. The code then scores the economy for you. If the macro score pops above 80, the model tells you, hey, it's safe to allocate heavily into tech stocks. Step 3.
If that score drops below 30, it signals a strategic retreat to bonds or cash. The crucial point here, the machine instantly processes millions of data points that would take you weeks to read, but you, the retail trader, get to manually execute that final decision.
Which brings us to section 4, the invisible advantage. So, we've talked a lot about how institutions basically have infinite money and infinite speed, but you, as a retail trader, actually have an ultimate superpower that the most well-funded Wall Street behemoths literally cannot replicate. You can turn your perceived weakness into your absolute greatest strength. Think about it. When a $10 billion fund wants to buy a stock, they have so much capital that they literally disrupt the market. Their sheer size aggressively pushes the price up as they are trying to buy, causing massive slippage. They are basically an elephant trying to hide in a phone booth. But your $10,000 retail account, you trade with total 100% invisibility. You can enter and exit the market with absolutely zero market impact. You are a ghost. And because of this invisibility, you can deploy true retail guerrilla tactics. You can build your quantitative models to specifically target mid-cap and small-cap stocks. These are smaller markets where massive funds simply cannot maneuver without exposing themselves and ruining their own trades. You can use your Semi-Quant Python scripts to detect unusual cash flows in these smaller arenas and then just operate entirely undetected by the giant algorithms. You don't fight them in the open field, right? You win in the margins where they are just too big to fit. So, as we wrap up this explainer, here is the absolute core takeaway you need to remember. Quant is a methodology to remove emotion, standardize your risk, and filter vast amounts of data. It is absolutely not a magic passive income button. Trying to build a 100% automated money machine as a retail trader is by far the fastest way to just burn through your capital. But using quantitative logic to survive, to physically protect your downside, and to strike exactly where institutions can't, that is exactly how you level the playing field. I want to leave you with this final provocative thought today to really challenge your own trading philosophy. Take a hard look at your current strategies. Look at the code you are writing right now or the tools you're using and ask yourself, are you building a bot just to gamble or are you building a system to survive? Because honestly, the answer to that question is going to determine your entire future in the markets. Thank you so much for joining me in this explainer and keep learning.